Right now, today, while you are watching this video, banks are making money from you. Not from your deposits, not from your savings, not from the account you opened years ago that earns you practically nothing in interest. From your debt, from the interest on your credit card that compounds quietly every single month. From the car loan that costs you thousands more than the car is worth. From the student loan that follows you for decades. From the mortgage structured specifically to collect maximum interest before touching a single dollar of your principal. From the overdraft fee charged the moment your account dips below zero. From the minimum payment system designed to keep you paying forever. Right now, today, while you live your life, the bank is getting richer from your financial stress. And the most infuriating part of all of this, it is not illegal. It is not hidden. It is not some conspiracy operating in the shadows. It is written in the terms and conditions you agreed to. It is in the contract you signed. It is operating completely in the open, in plain sight, and most people never see it clearly because nobody ever sat them down and showed them exactly how the machine works. Until today, because by the time this video is done, you're going to understand the debt trap completely, how it was built, how it operates, how banks extract maximum wealth from ordinary people while staying perfectly within the law, and exactly, step by step, how to get out of it and stay out of it permanently. This is not about hating banks. Banks are businesses. They do what businesses do, maximize profit. This is about understanding the game clearly enough to stop being the one who funds everyone else's profit while falling further behind yourself. My name is Cynthia, and this is the Wealth Rule. Let me start with a number that is going to stay with you. The average household carries approximately $103,000 in total debt. That includes mortgage debt, car loans, student loans, credit cards, and personal loans. $103,000. Now here is the number behind that number. On $103,000 of debt at average interest rates, the total interest paid over the life of those debts is approximately $67,000. $67,000 paid to lenders. For nothing. For no asset. For no product. For no service. Simply for the privilege of having borrowed money. $67,000 that could have been an investment portfolio worth $180,000 over 20 years at 7% annual return. That could have been financial freedom. That could have been options. That could have been the retirement that does not require working until your body gives out. Instead, it went to a bank, and the bank did not work for it. The bank did not produce anything for it. The bank simply owned the debt. And owning debt, structured correctly, is one of the most profitable businesses ever invented. Let me show you exactly how it works. Let me introduce you to two people. Same age, both 25, both starting their adult financial lives with similar incomes and similar starting points. Let's call them Taylor and Jordan. Taylor does what most people do. Gets a credit card because everyone has one and the sign-up bonus looks good. Buys a brand new car because the monthly payment seems manageable. Takes out a personal loan for a home renovation that felt necessary. Carries a balance on the credit card most months because life is expensive and the minimum payment is all that fits in the budget. Taylor is not reckless. Taylor is not irresponsible. Taylor is doing exactly what the financial system was designed to encourage ordinary people to do. Borrow. Spend. Pay minimums. Borrow more. Jordan does something different. Not dramatically different on the outside, but structurally different in one fundamental way. Jordan understands what debt actually costs, not the monthly payment, the real cost, the total lifetime cost, the opportunity cost of every dollar that flows to interest instead of to investments. And with that understanding, Jordan makes different decisions. Not perfect decisions, not zero debt ever, just decisions made with full information instead of without it. 10 years later, Taylor has paid approximately $34,000 in interest across all debts, still carries $67,000 in outstanding balances. Net worth, negative $12,000. Works hard every month and falls slightly further behind every year without understanding why. Jordan has paid approximately $4,200 in total interest across 10 years, almost entirely on a mortgage with a deliberate, aggressive paydown strategy. Has $41,000 invested. Net worth, $63,000 positive and climbing. Same income, same starting point, same 10 years, $75,000 net worth difference. From understanding how the debt trap works and making decisions accordingly, let's go through exactly how the trap is built, piece by piece. The first mechanism, the minimum payment trap. This is the foundation of the entire debt industry, the mechanism without which the credit card business model simply does not work. And it is so normalized, so embedded in how we think about managing money, that most people do not recognize it as a trap at all. Here is how it works. You carry a credit card balance. The bank requires a minimum payment every month. That minimum payment is calculated specifically, not to help you pay off the debt, but to keep you in debt for as long as mathematically possible while extracting maximum interest over that period. The minimum payment is typically between 1% and 3% of the outstanding balance. On a $5,000 balance, that is between $50 and $150 a month. $50 a month sounds manageable. $50 a month sounds responsible. $50 a month feels like you are handling it. Here is what $50 a month on a $5,000 balance at 22% interest actually produces. It takes you 30 years to pay off that $5,000. 30 years. And the total amount you pay over those 30 years is approximately $11,400. On $5,000 of purchases, you will pay $6,400 extra, more than the original balance in interest alone, on things you bought possibly decades ago, things you may not own anymore, things you have completely forgotten about. The minimum payment is not a kindness from the bank. It is a product. The most profitable product the credit card industry has ever created, because it transforms a one-time purchase into a 30-year revenue stream. Taylor pays the minimum every month and feels responsible for doing it. The balance barely moves. The interest compounds. The bank collects. Jordan pays significantly more than the minimum every single month. Not always the full balance, but always more than the minimum. The balance moves. The interest shrinks. The debt ends. The difference between paying the minimum and paying aggressively above the minimum on $5,000 of credit card debt is approximately $6,000 in interest and 25 years of financial obligation. From one number on a monthly statement, the second mechanism, compound interest working against you. We talk about compound interest on this channel constantly as the most powerful wealth building force available to ordinary people. And that is true. But compound interest is a force, and forces work in both directions. When compound interest is working for you in an investment account, in a dividend portfolio, in an index fund, it is the engine of wealth building. Every return generates more return. Every year, the growth accelerates. Given enough time, it produces outcomes that look almost impossible from the starting point. When compound interest is working against you, in a credit card balance, in a high-interest personal loan, in any debt that accrues interest on the outstanding balance, it is the engine of wealth destruction. Every unpaid interest gets added to the balance. Next month's interest is calculated on the higher balance. The debt grows even when you are making payments. The hole gets deeper even when you are trying to climb out. Here is the specific mathematics that makes this devastating. $10,000 on a credit card at 22% annual interest. Month 1. Interest charge, $183. Minimum payment, $200. Principal reduced, $17. New balance, $9,983. You paid $200. Your balance went down $17. $180 $3 of your $200 payment went to the bank. $17 went toward actually reducing what you owe. Month 2. Interest charge, $183 again, calculated on the $9,983 balance. Minimum payment, $199. Principal reduced, $16. The balance is barely moving. The interest is relentless. And if you ever miss a payment, the missed payment gets added to the balance. The interest compounds on a higher number, and the hole deepens immediately. This is how people end up in the situation Taylor is in. Not from recklessness, from the mathematics of compound interest, working against them month after month, while the minimum payment system makes it feel like they are managing. They are not managing. They are feeding the machine. The third mechanism, the teaser rate trap. This one requires attention because it is one of the most cleverly designed debt traps in existence. And it is specifically designed to feel like a financial win when you step into it. The teaser rate trap works like this. A credit card or loan is offered at an introductory interest rate, sometimes 0%, sometimes 1.9%, sometimes 3.9%, for a limited period, typically 6 months to 2 years. The offer feels genuinely excellent. 0% interest means you can carry a balance without paying interest. You can transfer existing debt onto this card and pay it down interest-free. You can make a large purchase and pay it off over time without the interest eating you alive. This is a real benefit. Used correctly, it can save significant money. Here is the trap hidden inside the benefit. At the end of the introductory period, if any balance remains, the interest rate jumps. Not gently, dramatically, to rates typically between 19.99% and 29.99%. And in many cases, the bank applies this new rate retroactively to the entire introductory period, collecting interest on the full original balance as if the 0% period never happened. The bank is not offering you 0% because they want to help you save money. They are offering you 0% because they know from decades of behavioral data that most people will not pay off the full balance before the introductory period ends. They know the human tendency to delay, to spend a little more, to assume there will be enough time. They are betting on your optimism, and they almost always win. The teaser rate is the fishing hook. The 0% is the bait. The retroactive interest is when the line gets pulled. Taylor signed up for a 0% balance transfer 18 months ago, had every intention of paying it off before the rate jumped. Life happened. The balance, when the introductory period ended, $2,800. The retroactive interest charge on the first statement after the period, $490 in 1 month. Jordan read the entire terms and conditions before accepting the offer. Set up an automatic payment that would clear the full balance 2 months before the introductory period ended. Paid 0 interest. Used the bank's promotional offer exactly as the bank hoped Jordan would not. The difference is not intelligence. It is information. The fourth mechanism. Fees that compound like interest. Most people understand that interest costs money. Fewer people fully calculate what fees cost over time, and banks have spent decades perfecting the art of the fee, small enough to feel negligible individually, designed to compound into significant revenue streams collectively. Let us go through the main ones. The late payment fee, typically between $25 and $40 per occurrence, does not sound significant, but a late payment also triggers penalty interest rates on many cards, jumping your rate from 19.99% to 29.99% immediately. That penalty rate can remain in place for months, even after you resume on-time payments. One late payment can cost hundreds in compounded additional interest over the following months. The overdraft fee, typically between $25 and $35 per transaction, on a $3 coffee purchase that takes your account 50 cents below zero. The bank charges you $35. That is a 1,166% fee on a $3 purchase. And if 3 more transactions process before you notice the overdraft, 3 more $35 fees. The annual fee. Many credit cards charge $95 to $695 annually simply for the privilege of holding the card. If the card benefits do not exceed the annual fee, you're paying the bank for the opportunity to spend money and possibly go into debt with them. The foreign transaction fee. Typically 3% on every purchase made in a foreign currency. On a $2,000 international trip, that is $60 for nothing. For a mathematical calculation, the bank's system performed automatically. The balance transfer fee. Typically 3% to 5% of the transferred amount. On a $5,000 balance transfer, that is $150 to $250 simply for moving debt from one place to another. None of these fees are hidden. They are all in the terms and conditions. But terms and conditions are written in the language of someone who does not want them read. Long dense. Technical. Designed to be agreed to without being understood. Taylor has paid approximately $680 in miscellaneous bank fees over the past 2 years. Not from recklessness, from not reading the terms. Jordan read the terms, banks the right accounts, pays 0 annual fees, has overdraft protection linked to a savings account that transfers automatically, has not paid a bank fee in 3 years. The 5th mechanism, the mortgage structure. The mortgage is the largest debt most people will ever take on, and it is structured in a way that maximizes bank profit so elegantly that most homeowners never fully understand what they agreed to until the loan is nearly paid off. Here is how mortgage amortization actually works. On a $300,000 mortgage at 6.5% interest over 30 years, your monthly payment is approximately $1,896. In month one of that mortgage, $1,625 of your $1,896 payment goes to interest. $271 goes to reducing the principal. You pay $1,896. The bank takes $1,625. Your debt goes down $271. This ratio shifts gradually over the life of the loan. By month 180, 15 years in, approximately $1,200 goes to interest and $700 goes to principal. By the final years, the ratio has reversed and most of your payment is reducing principal. But here is the total picture that most people never calculate. On a $300,000 mortgage at 6.5% over 30 years, the total amount paid is approximately $682,560. You borrowed $300,000. You paid back $682,560. The bank received $382,560 in interest from one mortgage, from one customer, over 30 years. And if you sell the house after 10 years, as millions of people do, and take out a new mortgage on the next property, the amortization resets. You go back to month 1, back to paying mostly interest, back to the beginning of a structure specifically designed to collect maximum interest by front-loading it into the early years when the balance is highest. This is not fraud. This is mathematics. This is how interest on a declining balance works. But it is mathematics that benefits the bank enormously and that most homeowners do not fully understand until it is explained clearly. Jordan understood this before signing the mortgage, made one additional principal payment per year, approximately $1,900, directed entirely at principal reduction. This single habit reduces the total loan term by approximately 5 years and saves approximately $58,000 in interest over the life of the mortgage. One extra payment per year. $58,000 in savings. The bank was counting on Jordan, not knowing that was possible. The 6th mechanism. The debt cycle. This is the mechanism that traps people most completely. And it is not a single product or a specific fee. It is the compounding effect of multiple debt obligations interacting with each other to create a financial situation that feels genuinely impossible to escape. Here is how the debt cycle builds. It starts with a manageable credit card, then a car payment, then a personal loan for something that felt necessary. Then the credit card balance grows because the car payment and the loan payment left less money for monthly expenses. So the credit card covers the gaps. The balance grows. The minimum payment grows. The minimum payment leaves even less money for monthly expenses. The credit card covers more gaps. The balance grows further. At no single point in this process did the person make a dramatically irresponsible decision. Each individual step seemed reasonable in isolation. The car was needed for work. The loan covered a genuine need. The credit card covered genuine shortfalls. But the cumulative structure, multiple debt obligations, each with their own interest, each claiming a portion of monthly income, each leaving less available for the next month's expenses, creates a spiral that tightens with every rotation. This is the debt cycle, and it is extraordinarily difficult to escape once fully inside it for one simple reason. Escaping requires generating surplus. Surplus requires reducing expenses below income. Reducing expenses below income is nearly impossible when debt obligations are consuming 35% to 50% of monthly income before a single living expense is covered. The cycle was not created maliciously by banks. It emerged naturally from the intersection of products designed to maximize revenue and human psychology that underestimates future financial strain. But banks are absolutely aware of it, and they design their products, the minimum payments, the credit limit increases, the balance transfer offers, the personal loan offers that arrive when a customer is already stretched to keep people cycling rather than escaping. Taylor is in the cycle, has been for 3 years. Works hard every month. The numbers never improve. The stress never reduces. The path out is not visible. Jordan was never in the cycle, because Jordan understood the structure before entering it. Now let me shift completely, because understanding how the trap works is only half of this video. The other half is the escape plan, the real one, not the one that requires perfection or dramatic sacrifice or a financial windfall. The one that works for real people starting exactly where they are right now. Escape step 1. Know your complete debt picture. Every single number. This sounds obvious. It is not done by most people in debt. Most people have a vague sense of what they owe. They know the monthly payment. They know it is stressful. They avoid looking at the full picture because the full picture is painful. But you cannot escape a trap you cannot see completely. Sit down this week with every debt you carry, every single one. Write down the creditor, the outstanding balance, the interest rate, and the minimum payment for every debt in your financial life. Look at the complete picture. Add up the total. Calculate the total interest you will pay if you continue paying only minimums. This exercise is uncomfortable. It is also the most important financial exercise you will ever do, because seeing the complete picture in specific numbers, not in a vague, stressful cloud, is the first step toward changing it. You cannot attack what you cannot see. See it completely, then attack it. Escape step 2. Stop adding to the debt immediately. Before you can pay down debt, you have to stop the debt from growing. This means for the duration of your debt paydown, the credit card balance does not increase. New purchases go on the card only if they can be paid in full that month. Financing new purchases while paying down existing debt is running on a treadmill. The ground never moves. Cut up the cards if necessary. Move to a cash or debit only system temporarily. Remove the saved card details from online shopping platforms. Make spending slightly more difficult so that the automatic impulse purchase requires a conscious decision. The debt stops growing the moment new debt stops being added. That moment is the beginning of the actual escape. Escape step 3. Use the avalanche or snowball method and stick to one. These are the 2 most effective debt paydown strategies ever developed. Both work. The right one depends on your psychology. The avalanche method. Pay minimum payments on all debts and direct every extra dollar toward the debt with the highest interest rate first. Mathematically optimal. Saves the most money in total interest paid. Requires patience because the highest interest debt is not always the smallest balance. The snowball method. Pay minimum payments on all debts and direct every extra dollar toward the debt with the smallest balance first. Not mathematically optimal, but psychologically powerful. Each debt eliminated completely provides a genuine win, a motivation boost, and a freed-up minimum payment that can be redirected to the next debt. Jordan used the avalanche method, attacked the 22% credit card first, paid it off in 14 months by directing an extra $340 a month at it, then redirected that $340 plus the freed minimum payment to the next debt. The debt paydown accelerated with every balance cleared. This acceleration is the key feature of both methods. As each debt disappears, the monthly amount available for the remaining debts increases. The paydown gets faster. The momentum builds. The end comes sooner than the starting point would suggest. Escape step 4. Negotiate with your creditors. This is the step that most people never take because they assume it is not possible. It is. Banks and lenders negotiate on interest rates, settlement amounts, and payment plans far more often than their marketing would suggest. Because a negotiated lower interest rate that keeps you paying is more profitable than a customer who stops paying entirely and defaults. Call your credit card company. Ask specifically for a lower interest rate. Cite your payment history. Cite competitive offers. Ask to speak to a retention specialist. The answer will not always be yes, but it is yes more often than most people expect. And a reduction from 22% to 17% on a $5,000 balance saves hundreds in interest over the paydown period. If you are genuinely in financial distress, if the debt has become unmanageable, most creditors have hardship programs that reduce or suspend interest temporarily while you stabilize. These programs exist. They are not advertised, but they are available to people who ask specifically for them. You have more negotiating power than the credit card company wants you to believe. Use it. Escape step 5. Build the emergency fund simultaneously. This is the step that most debt paydown advice gets wrong. They say, pay off debt completely first, then build savings. The problem with that sequence is that without an emergency fund, every unexpected expense goes straight back onto the credit card. 3 months into your debt paydown, your car needs a repair. You do not have cash. It goes on the card. You are back where you started. Motivation destroyed. Progress erased. Build a small emergency fund, $500 to $1,000, before attacking debt aggressively. Not the full 3 to 6 months. Just enough to cover the most common, unexpected expenses without reaching for the card. With $1,000 in an emergency fund, the car repair does not destroy your progress. The unexpected medical bill does not send you backwards. The small financial emergencies that are not really emergencies, they're just life, stay manageable without debt. The emergency fund is not competing with the debt paydown. It is protecting it. Escape step 6. Redirect every freed payment to investing immediately. This is the step that transforms debt paydown from financial recovery into genuine wealth building. Every minimum payment you eliminate through debt paydown is money that was previously going to a bank. The moment a debt is cleared, that minimum payment amount does not get absorbed into lifestyle spending. It gets redirected immediately into an investment account. Taylor's minimum payments across all debts total $840 a month. That $840 every month is funding bank profits, funding the exact wealth gap between Taylor and the bank. The day Taylor's last debt is cleared, that $840 a month redirected to an index fund at 7% average annual return over 20 years is $497,000. The same money going to a completely different place, from bank profit to personal wealth. That is the complete transformation. Not from recklessness to responsibility, from funding someone else's wealth to building your own. Now, let me give you the complete numbers. The full picture. Taylor and Jordan. Same income. Same starting point. Same 10 years. Taylor paid $34,000 in interest across all debts over 10 years. Still carries $67,000 in outstanding balances. Net worth negative $12,000. Jordan paid $4,200 in interest, almost entirely on a mortgage being aggressively paid down. Has $41,000 invested. Net worth positive $63,000 and growing at approximately $7,000 a year from investment returns alone. $75,000 net worth difference after 10 years. $75,000 that Taylor gave to banks, that Jordan redirected to assets. Same income, same 10 years, same city. One understood the trap. One built wealth instead of funding it. Now I want to speak directly to you, because this video is not about blame. If you are carrying debt right now, significant debt, stressful debt, debt that feels like it will never end, I need you to hear something clearly. You did not get into debt because you are irresponsible. You got into debt because you were handed products specifically engineered by some of the most sophisticated behavioral economists and psychologists in the world to make debt feel normal, manageable, and reasonable until it is not. The credit card company did not explain the minimum payment trap at sign up. The car dealership focused on the monthly payment, not the total cost. The student loan servicer did not show you a compound interest projection before you signed. The mortgage bank did not walk you through exactly how much of your first 10 years of payments would go to interest. You were not given the information that would have changed your decisions. But now you have it, and the path forward is not complicated. It is not easy, but it is not complicated. See the complete picture. Stop adding debt. Pick a paydown method. Negotiate where possible. Protect the progress with a small emergency fund. And the moment each debt disappears, redirect that payment to building something that works for you instead of against you. That is the escape plan for real people starting exactly where they are. I want to leave you with one final thought. Banks are not the enemy. They are businesses doing exactly what businesses do. Understanding how they make money is not about anger. It is about clarity. Because the moment you see the debt trap clearly, the minimum payment system, the compound interest working against you, the teaser rates, the fees, the mortgage structure, the debt cycle, it loses most of its power over you. You cannot be trapped by something you can see completely. See it, understand it, build the escape plan, and start today. My name is Cynthia, and this is the Wealth Rule. Drop a comment right now and tell me, which part of this video hit closest to home for you? The minimum payment trap? The mortgage structure? The debt cycle? I read every single comment, and I genuinely want to know where you're starting from. And if you know someone who is working hard every month and falling slightly further behind without understanding why, share this video with them right now. It might be the most important thing you do for them today. I'll see you in the next one.